So welcome everybody, and thank you for inviting me to speak to you today. I cannot tell you how happy I am today because the markets are closed. That's the single best thing that could have happened after last week's bludgeoning, fear, ending in somewhat of euphoria. It has been it has been unbelievably trying, and unless you were sitting in cash, you have to feel pretty much the same way that I do about this. So I would say that most of us somewhere along the week or every day of the week were in semi-panic or hysteria. Not because we haven't been through events before, we all have, but every event is a bit different. And I had been writing in my quarterly investment outlook to my clients that the stock market was getting so overvalued. You know, you just don't have 11 years of a bull run continuing to go when PE ratios had expanded so greatly. Bond market was just doing kind of okay, you know, no runs, no hits, no errors. And we kept looking for the tripwire. What is going to be the tripwire to create an event that is going to nuke everything? And lo and behold, it wasn't a financial tripwire. It ended up being a health-oriented tripwire that bled into the global economic environment. So here we are, many people in a panic over their portfolios, many people looking at it as somewhere there's going to be an opportunity, and we're going to talk about all of the above. I specialize in bonds, but I have to tell you, we were not spared. We were not spared at all during this major meltdown. This meltdown started Sunday. I was working all Sunday, had my Bloomberg on, and then my husband heard me scream, "Oh my gosh, Putin has started an oil war and Saudi Arabia is going to fight it." So that was the beginning, mixed with what was going on with the virus, and you know all the rest. So every financial writer, everybody on CNBC, everybody on Fox Business News has been talking about the lurch into bonds. People kept buying bonds hand over fist as we have seen the virus get worse and worse globally, unfortunately inflicting itself and taking many, many lives, and people wanted safety. So what did they do? They ran to U.S. treasuries. They ran to U.S. government agencies. And the rest, they didn't run from, they ran away from. So people couldn't buy treasury bonds fast enough. People couldn't buy government agencies fast enough. And hence we saw the most volatility in the treasury market than we have seen in many, many years. I have been doing this since 1979, and the volatility with treasuries was something that was unbelievable through the day, through the night, in Japan, etc. So let's, I'm big on data points. Let's take some data points. Here's where we stand as far as corporate bonds are concerned. People always, when they come to interview us, to hire us, they say, well, you know what, I want a AAA rated corporate bond portfolio for my pension. Okay, that's a very small market. Two names are in that market, of which I'll share with you in a minute. AAA rated, a minuscule 100 billion. AA rated, 431 billion. Everything that you are talking about when you talk about or read about corporate bonds are all in the triple Bs, triple B plus, triple B, triple B minus. And you might say to yourself, gosh, I remember in the 1990s and the 1980s when there were tons of AA's and AAA's. Well, that was right. But most of these downgrades were not and have not been because of bad economic conditions. They have been self-inflicted by the CEOs and the CFOs adding debt upon more debt on their balance sheets. Why would they do something like that? Well, it's forgivable if you're going to use the cash as CapEx and expand, hire new people, add to R&D. And they did a little bit of that, a little bit of all of the above. But mostly, especially the last 10 to 11 years, they have issued bonds, debt, in order to conduct share repurchases that you equity investors love, and increase dividend payouts. When money was almost free in the sense that the yields have been so limbo low, corporate America thought that was the best use of their money. And then we go in and out of a mild recession, a mild slowdown, to a slam-a-dam-a-ding-dong recession, and everything starts coming apart at the seams because they can't make the revenue numbers. Their earnings start to collapse, and debt service, the amount of money they have to service the bond debt, their line of credit debt starts to diminish, hence downgrades. So we are, when I was a young girl starting out in this business, I believe there were 60 or 63 different AAA rated names. Now there are two, only two. I rest my case as to how corporate America has denigrated their balance sheet. But before we get into the nitty gritty, let's take some data points. Now I had to shoot these PowerPoints to AAII on March 11th, that was Wednesday, and everything has changed since then. But this gives you some kind of idea as to why, even though we've got all this corporate debt, even though we've got triple the amount of treasury debt that we had in the 2008-2009 financial collapse, rates are low. Rates are limbo low. And I always have people ask me the following: who wants to buy bonds at these low rates? And my answer is everybody, particularly treasury bonds. Absolutely, it is the safe haven, even though we've got almost $17 trillion of treasury debt. So when I say who wants to buy it, not just retail investors like you, not just pension plans like you might be in, not just IRAs, but major central banks, major global corporations. So let's just stop for a minute and think. If you were the CEO of a German insurance company, and you clearly have actuarial liabilities, so much money that you know you're going to have to pay out over the next 30, 40, maybe even 50 years, would you rather have a 5-year German Bund at negative 0.92% or a 10-year treasury, which right at Friday's close was 0.96. So you can see how much the treasury yields have backed up since Wednesday. Wednesday it was 0.75%. Friday afternoon it was 0.9%. So if you were a CEO or a CFO of a German insurance company, where would you want to put your money? In the U.S. Treasury market. If you were an Italian CEO and wanted to put your money in a in a 5-year kind of tranche, you would buy U.S. Treasuries. You wouldn't buy the Italian bond at minus 0.66%. So these negative yields that are out in the marketplace, and they have been out here for a long time, Japan, Germany, France, Italy, it's inconceivable that they still exist, but I think they are going to stay negative and maybe even go negative. And if you learn nothing from me today other than this one phrase, this will have been a very big success for me. And that is, we believe interest rates in the United States are going to stay lower for longer. No question about it. On an intraday basis, at the hysteria of the global viral crisis, we saw 10-year treasuries go to 0.36. They didn't close there. They bounced, they bounced right back. But that was something I thought I would never live to see. So even though we're at 0.96, that's still sub 1%. And I bet most of you never thought we would see a sub 1% 10-year treasury. I certainly didn't. I knew rates would stay lower for longer. I've been saying that for the last 3 to 4 years. But I think that the peril here is if things get a lot worse with this particular virus, we could, in the United States, go to negative rates. Frightening thought, frightening idea, but this seems to be the trend. And clearly, if you heard Secretary Treasury Steve Mnuchin being interviewed on CNBC yesterday by Jim Cramer, Jim really was very poignant. You know, are you going to liquefy the system? Will you be there for corporate America, for mom and pop? Will you be there? And the answer was, they will liquefy the system, both the Fed, the government. They will all speak in one voice through the president, and the liquidity will be there. So don't be surprised if rates go a lot lower for a lot longer than we think. And I believe most of us are baby boomers that are attending AAII's presentation today. So we've been through the ringer. 1981, I'll never forget 1981, when interest rates went up to, Treasury rates went up to 15%. You could have locked and loaded a CD for 1 or 2 years at 20%. And to go through the whole gambit of high rates like that to low rates like this is really quite a round trip. We may sometime go back to 15% in treasuries, but my bet is none of us will be around to live through it. It's quite astonishing, but nevertheless, this is where we are.
Marilyn?
Yes.
This is a question.
Okay.
From Edward Don. He says, bond premiums and discounts are now being reported to the IRS as OIDs and annual premiums by brokers. Can you touch on what the current tax rules are for secondary purchases?
Great question. Thank you for asking. Okay. So when you buy a taxable corporate bond or a treasury bond or a government agency bond, and let's say it's an old bond. Let's say it's 10 years old and it's got 5 years left to mature. So it's a 5% coupon and you pay, let's say, $1,100 per bond. That's called a premium. That $100 is a premium because in 5 years, it's going to go to par value, $1,000. So what your brokerage firm does is amortize that premium daily, meaning every day, every week, every month that you get that much closer to maturity, that premium diminishes a little bit more, and then it finally is extinguished. So what you do with that premium amortization, it's on the first page of your 1099. It shows taxable premium amortization, and let's say it was $2,200. You have two options on that. The first option is you can take it as an annual deduction against the income that the bond is generating, or you can wait until the bond matures and take it as a capital loss. Your choice. So this is a great idea. Now, the rules are very, very, very strict. You can't 1 year do one thing, the other year do the other thing. You and your CPA have to decide whether you're going to amortize and take it as a deduction annually or whether you're going to capitalize it and take it as a capital loss. I personally, on my 1099s, take it as a amortization because I want the deduction now. I don't want to wait till later. So that's one thing. And make sure that you stick to the rules. But I think that this is this is a very clear and cut situation. Bonds that you buy at a discount, these rules are much more cumbersome and clunky, and they can be very different for taxable bonds versus tax-free bonds. I got to back up for a minute. I just remembered. If you own municipal bonds, that premium that is being amortized cannot be taken as a deduction and cannot be taken as a capital loss because they are tax-free bonds. So let me make sure that you understand that caveat. So the bonds that you buy at a discount, let's say that you buy a municipal bond that's a low coupon, like 1.5%, and you buy it at $950, and it's going to come due in 7 years, and every year you're going to see a little accretion. So depending upon the, how long the holding period is, depending upon a bunch of variables, some of that discount can and will be taxed as ordinary income, and some of that discount will be taxed as tax-free income. So we have on Bloomberg a screen that's called F-tax. So before we buy anything at a discount, we say, okay, is this going to be ordinary income here for a portion of it, or is it all going to be tax-free? And we never want to buy a tax-free bond in which it's going to generate ordinary income. You can buy tax-free bonds, premiums, discounts, but those rules are a little clunky. Now back to the OID. Original issue discount bonds are usually amortized or accreted, every year, and a portion of that ends up being taxable. So I believe his name is Ed. Ed, good question. Very, very detailed answer from your CPA, but I would say if you stick with bonds that are at par-ish or a little bit above par, you have much more flexibility. I hope that answers you. Okay, so back to global investors that are desperate for yield and domestic investors that are desperate for yield. I wanted to take a 20-year look at where treasuries were and where they are today. So January 2020, 6.79%. For me, that seems like that was an eternity ago. For me, when we were buying bonds around that yield for corporations, corporate bonds, or 5% or 5.5% for municipal bonds, it seemed like you were really getting something for your money. Well, now that certainly isn't true. A 10-year bond at 0.96. The income deterioration has been heaped upon us by all of the global central banks, not just the Federal Reserve. Clearly, the quantitative easing that was done in the 2008-2009 financial debacle started it all off. And nobody anticipated that we would have global negative yields. The underpinnings now are very, very strong. $15 trillion of negatively yielding bonds. And as I said a little bit earlier, it is so difficult to get your arms around what a negative yielding bond means. It means simply that you buy a new bond that's issued and it's got a 1.5% coupon. You have to pay the issuer 1.5% for holding your money. If you go and get if you are a French citizen and you get a 1-year CD and that 1-year CD is 0.75%, you have to pay the bank 0.75% for holding your money. It feels like Alice in Wonderland's topsy-turvy world. It really does. Nevertheless, the global central banks, look how many times they cut interest rates, about 90 times in 2019. That's all the global central banks, obviously. So they've distorted the markets, the bond markets. They have distorted lending practices and borrowing practices. And I must say, I don't think that distortion is over, unfortunately. So that's kind of like my wind up here. Now let's talk about some of the trends we're seeing and the trends that will affect income deterioration, or maybe the opposite, maybe an increase in your income for your fixed income portfolio. And, you know, obviously I can't see your faces and I don't know you, but I would say that I hope you all weren't 100% in equities since the beginning of the year. I mean, there are times when how much more do we expect to squeeze out of Apple, Facebook, Microsoft? And it all is dependent on, you know, the economy, how well the economy is doing and how sales and earnings do from all of the major companies. And this has and was the biggest bull market in U.S. history, the longest economic positive market we've had since the Civil War. And now we see that it looks like it's taking a big breath. What made it be the longest bull market? What made it be the longest economic recovery we've ever had? Well, it's the megatrends. It's the technology. The technology extended these megatrends, or created these megatrends, I should say. And I don't want to read this list to you. I could have filled up the whole darn page, that's for sure. But I think it's important to go back to Clayton Christensen, who recently passed away, when he came out with his book about disruption and how technology is going to disrupt everything that we know as sacred and familiar to us. So I tried to make a quick and dirty list of the disrupted companies and the disruptor. And I'm sure if we could have everybody raise their hand and shout out a different disrupted company and the disruptor, we'd have to fill 5 pages like this. But the point is, when we invest, we have to consider, are we investing in an industry that has been disrupted? Hotels have been disrupted, certainly because of the virus, but by Airbnb. Has it affected them dramatically? Well, probably on the lower end, yes. On the high end, no. But when you're looking at stocks or you're looking at an ETF and the underlying shares in that ETF, it is mandatory to see what sector you're in and whether you can be disrupted. And that's exactly what we do in bond land too. We don't want to be in the old dying sectors knowing that disruption is on its way. Certainly the Venmo, PayPal, Apple Pay, Bitcoin has disrupted money and credit cards. Has it disrupted banks yet? No, because big corporations are not going to be able to borrow from there. And they're not going, and Venmo, PayPal, Apple Pay, Bitcoin aren't going to be able to help companies have lines of credit, etc. But I think it's important to keep, not in the back of your mind, but in the front of your mind, the disrupted versus the disruptors, and only go with the disruptors. A few of the disrupted, maybe, but certainly we have seen, look at American Telephone, Verizon. I'm a cord cutter. Are you a cord cutter? Has that hurt them? Well, that certainly forced American Telephone into media and things that they have never been in, and the jury's still out as to whether that's all going to that is all going to work out. But my bottom line up here, productivity is a recovery extender. And if productivity is enhanced, which it is by technology, then you want to be on that cutting edge, whether you are buying individual bonds, whether you are buying an ETF or a bond fund in which you must check out what the portfolio looks like, or whether you're buying stocks. You must look at these mega trends. And these mega trends are having a shorter and shorter life from beginning to their dramatic imprint. All right, now I'm going to get into some granular information for you. Granular in the sense that here are some of the challenges as a bond portfolio manager that we are having. So I mentioned that corporate America has taken on a lot of debt over the last several years. Some of it went to CapEx, a lot of it didn't. It went to share repurchases and higher dividends. And when you own bonds, depending upon what the covenants are and what the rules are per company, per bond, there have been many companies that have tendered their bonds saying, okay, here's Johnson Controls. Company provides building products, technological solutions, air conditioning system, HVAC controls, blah, blah, blah. You can read the sentence. It's a good quality company, strong in the B's. And they decided, you know what? We have this $500 million issue, the 3 5/8 due July 2nd of 2024. And they decided, well, we can refinance that issue at less than 3 5/8 and push out the maturity to maybe 2030 or 2035, so we don't have to have a 4-alarm fire drill in May or June of 2024 to refinance this $500 million worth of bonds. So we bought these bonds for clients, and when we were offered to tender, we said, okay, we'll tender these. And the $500 million had people that didn't tender them. And now there's only 31.4 million outstanding. So my question, which is up on the top, are there any circumstances in which you should invest in non-rated corporate bonds? The answer should be yes, I'll check it out. Because what happens is we went from a $500 million issue to 31 million and change. And the rating agencies said, well, we're not going to bother rating $31 million in bonds. So they yanked those really good quality ratings. But it's still the same company. You still have the same debt service coverage, assuming revenues and income are and earnings are pretty much the same. But what happens is these bonds start trading at a discount to other Johnson Control bonds, and you maybe, and most probably, will be able to buy bonds that have been, you're looking at the tail of the tender, that's what we call it, at significantly higher yields than you could have bought anyway. So we like this idea, even though they're non-rated. They're not non-rated because they're drunk. They're non-rated because there's too few for the rating agencies to look at. Here's another example. Endeavor Logistics. It was Tesoro Logistics. Then it was bought by Endeavor Logistics. And then it was bought by MPLX. We bought these bonds, I would say 2 years ago. The takeover happened. These bonds are 5.25% coupon due January of 2025. So here is another quandary as a bond portfolio manager that we were faced with. The amount that was originally issued was $750 million. They tendered for the bonds. The majority of holders said, yeah, we want out, because what happens is they give you a little, we call it vigorish, vig, a little bit more for the bond than it's really worth in the marketplace to entice you to say, yes, you'll tender. Well, tell me what you would have done. Our clients are in at a 4.35% yield. The ratings are going to be withdrawn. There's only 42 million. What would you do? Would you hold on to it? Or would you have tendered or sell the bond and buy another corporate bond that is half, maybe half of the yield of that 4.35%? Our decision was, we're going to hold it. We follow the company. We know what they do. We're not scared of the 42 million. Could we get out of it? Probably pretty. It wouldn't be that easy, but we could probably get out over the course of a couple of days, assuming that we don't have a situation like last week. And hence, if you said, well, you won't be able to get a 4.35 today if you bought a little piece of that 42 million tail, but you'd be able to get a significantly higher yield than something that is 5 years to maturity and a decent investment grade. So tender offers are going to be even more fast and furious as these rates stay low due to the virus and due to all of the liquidity that's being that's flooding into the system. I think it's important that you can know that you can hunt and peck around and find some little gems out there that are going to yield you much more than just buying an ETF, an exchange traded bond fund, and saying, okay, I'm going to get 2.25%. I guess that's it. So bond tenders are, they were fast and furious. Then they kind of pooped out for a while. Now they're going to happen again. And let me show you just a partial list, really partial, about how this all works. So American Telephone has some 6.5% bonds due March of 2029. It was originally a $3 billion issue. And as Telephone promised, they would start to pay down debt after their humongous purchase of the entertainment Time Warner. Now left is 115 million of those same bonds. Some people did not obviously want to take the deal because they were locked and loaded into such a decent yield with an okay company. It's got a bloated balance sheet, but it is working on paying down that debt. So, I'm telling you, you can hunt and peck, just do a little work. And many of you are retired. So it's worthwhile getting on your Fidelity site, getting on your Schwab site, getting on any of the sites that you would look for bonds and see whether or not there's some of these tendered bonds that have a little tail on them. CVS. Okay, CVS did a big acquisition. Now they're paying down debt like holy tamale. Here are some 6.25% bonds due in 2027. An original $1 billion issue, now $371 million. That's a bigger tail than almost all of these. But nevertheless, it's not trading as liquidly. So if you are willing to give up some liquidity for a higher yield, that's how you ameliorate your income deterioration. Same thing with Celgene, originally $1 billion deal, now $38 million. Same thing with CBS, although I don't really like the company, how it's not performing, but nevertheless, I think that the bonds are what we say in bondland money good, $100 million down to $45 million. Here is a real estate investment trust, LPT, which is now PLD, Prologis, to 2029, down to a paltry 38 million, but a good quality company. Same thing with Whole Foods, same thing with Viacom. So there are lists and lists of companies like this that have tendered for bonds in which there have been holdouts like me. Now, would I be a holdout if my clients were in like at a 2 or 2.5%? No, I would tender them and say goodbye and go into something that is hopefully at least the same yield or even higher. But the yield for me as a portfolio manager is clearly one of the major drivers as to whether I hold them or whether I fold them. So if this happens to you, you have to make that same decision. And on the other side of the ledger, if you can find some of these, you will be rewarded income-wise because the yields will be anywhere between a paltry 10 to maybe 40 basis points higher than a bond that is $1 billion issue issued by the same company. Any questions about tenders? Okay, Celia, just break in if there is. Okay, my curtains are folding here. So the bottom line, I always think about the bottom line. Do you or don't you scrape for extra yield? In my tender examples, you have to ask yourself, will you or won't you give up liquidity? I'm willing to give up liquidity, and I'm not buying 25s for individual peoples. I'm buying 2 million and parceling them out in 25s and 50s. Anybody who has money, and I like that position, then we would buy a 3 to 5% allocation in that name. And equally as important, if you're offered a tender option, do you tender or don't you? And flexibility is really the bottom line. When I gave you, I think my third slide, talking about there's $100 billion in AAA bonds. The two names are Microsoft and Johnson & Johnson. That is fixed income perfection as far as their balance sheets are concerned. I do say, with all of the litigation Johnson & Johnson has right now, between talc and some other things, I do believe that they will be downgraded. I think that they will no longer be AAA. I think they'll probably go down to AA+ or AA-. Some analysts think that ExxonMobil is AAA. No, it is not AAA by Moody's and Standard & Poor's, even though I still think that the rating agencies and the ratings of the bonds should just be used as a kind of reminder that you need to do your own work, because they're still conflicted every which way and back. Nothing has changed with these rating agencies since the 2008-2009 financial debacle. So you have to ask yourself what you're going to do, those 3 bullet points, whether it's a tender, whether you give up liquidity, and are you going to scrape for extra yield to buy something that's going to be a little bit liquidity challenged. Boy, I'm going fast with no questions. Yikes, Cecilia, I might not be going till 10:15. Anyway, more examples of a bond manager's dilemma regarding no tender, tender. This is an example of there was no tender offer here, but you have to take a look at whether or not you are in the proper sector. And if you're not in the proper sector, your dilemma is, do you sell or do you gut through it? Aptiv used to be called Delphi. You can see at the bottom, it's in the commercial vehicle sector. It's in the car sector. It designs and assembles the car's electrical architecture. It creates software. It is the favorite of the whole sector, of the whole automobile parts and OEM manufacturers. And it is the darling of that sector, but the sector is so out of favor, it isn't funny. Look at GM, look at Ford. I mean, it's just bad, bad, bad. And all the feeder companies that go into GM and go into Ford, you know, there's no car sales hardly at all in China, which has been the automobile industry's big, big plus. And we're going to see fewer and fewer automobile sales here in the United States as people continue to remain trapped indoors for at least 2 weeks, that's for sure. So if you are a bond manager and you say, I've got this bond, it's a good AAA, their balance sheet is good, it's the darling of the sector, but it's the wrong sector. How are the earnings doing? Earnings are still positive. They're probably going to diminish and maybe they will go negative depending upon how long all of this takes. Revenues are fine. They've got free cash flow. That's really good. So what's the driver? Why am I even talking about this? Where am I going to get 4.05% or even close to it in 4 years for my clients? So this is not a tender offer. This is just a decision. Do I stick with this sector that is not doing very well and say I'm going to gut it out because that 4.05% yield is gold. It's absolutely gold to clients. And that's what we've done so far. Doesn't mean we won't sell them, but selling them like last week or this week would have been a death knell, because as you read in today's Wall Street Journal, as you're going to read in this weekend's Barron's, I was able to skim both of them before I got online with you. The credit markets seized up. I thought I was in a Wayback Machine all week in the fact that call a broker. And I'm not talking about any little schlocky brokerage firms. I'm talking about my main guy at Morgan Stanley's desk in New York saying, I'm looking for a bid on XYZ. Okay, Marilyn, we'll call you back. 10 minutes pass, 20 minutes pass, 45 minutes pass. It's not interested in calling me back because there's no bid. We use some of these electronic systems, both directly and indirectly, and the bids were horrible, horrible. So you don't want to sell into that, and you don't want to sell into a panic. I have a client that, he's a pretty big client. He's got a $9 million portfolio. And I was talking to him. He's a real calm guy. And we were going over every credit, and we got to Expedia. And he goes, Expedia, nobody is making any reservations at hotels or at the airlines. I said, I know, but these bonds are due August, not August of 2025, August of 2020. Looking at their balance sheet, looking at the cash on hand, it looks like they're going to make it. I'm not worried. What does he say? Sell them. You know what? My philosophy is, it's the client's money. If that's what they want, that's what we're going to do. So we go out to get a bid. And at first, the best bid comes back at $980 a bond for every 1,000 face value. These bonds are due in August, ladies and gentlemen. And so I said to that 98 bidder, I said, you have got to be kidding. You will not make that much money on this trade. It was more than just a retail size trade. It was $250,000 because of the heft of this particular account. And so I said to him, I said, you either get me a better bid, or we're done for the day. So he comes back, he goes, I apologize, our desk shouldn't have been so piggy. No kidding. And we'll give you a bid of 99 and a quarter. From 98 to 99 and a quarter on $250,000, that's significant. So make sure if you are buying or if you are selling and you're talking to a live person in that buying and selling, you have to negotiate with them. So I guess I strayed a little bit from my active bonds, but it's not just the sector, it's the execution. And I know a lot of you, if you are buying and selling bonds, you're doing it online, you've got to improve your online skills, I think, in putting in limit orders, putting in, prices that you want to be hit at in order for you to own them. So all kinds of bond market manager dilemmas, but I don't think they're any different than your dilemmas unless you're buying funds.
Marilyn?
Yes.
Question. This one comes from Paul Harms, and it says, how do you judge the liquidity of a bond?
Paul, that I think I'd have to get out a Ouija board after last week in order to tell you and give you an answer on that. Usually the bid and ask spread on munis is wider than the bid and ask spread on corporates, because corporates trade every day, all day. A lot of munis are purchased and are put away and don't trade for 6 months or a year. And I think that it's, when you're looking, if you're looking online, Paul, you have to look at the bid and ask. And if that bid and ask spread is a point or 3/4 of a point for the 25 or 50 bonds that you want to buy, that's too much. That's too much. And it might stay that way all the next week until the liquidity that the president and the Treasury Secretary talked about, until the liquidity starts to not leach in, but flood into the system. The problem here is the brokerage firms and the banks do not want to take bonds into their inventory and be sitting with them. They want to buy them from you and buy them from me and flip them out immediately, have a prearranged buyer right there. They're very, very reminiscent of the financial credit crisis in 2008, 2009. At least there are some bids and offers around. I would say if you are trading 25s and 50s for corporates, it's probably, the spread should probably be 1/4 to 3/8 of a point. For munis, a little bit more difficult because they do not trade all day, every day. And it could be as much as a point, which really wreaks havoc on your yield, or it could be as little as 3/8 of a point. So it's my answer, and I don't mean to be a weenie about this, it's a fluid situation. Any other questions, Celia, before I move on? I hope I answered him. Okay.
No questions at this point. Thanks, Marilyn.
Okay. So I'm here to give you actionable ideas, not just how to and this and that. Here are some actionable ideas. These are positions, corporate bond positions, that our clients own and that I own personally in my own IRA. I don't want to insult you by reading what they do for a living, but on the last 2 pages of your handout, hopefully you got that, the corporate bond recommendations tells you that Broadcom designs and develops analog semiconductors. Gaming and leisure, I must talk about that. You may not know that very well. It's a real estate investment trust and owns and leases 44 different gaming properties across 16 states. I really like these bonds. I think there's a lot of yield, even though it's what we call split rated. BA1, Moody's thinks that they're junk, and everybody else thinks that they are investment grade, although low investment grade. I think they're just fine. Hasbro, Hasbro, toy company. Hughes Satellite, you may not be so familiar with Hughes, except from the advertisements on TV when they advertise, you should have Hughes Satellite, a phone system. Well, Hughes is much bigger than that, much bigger than just supplying phone systems to rural America. How do the ships navigate? How do the planes navigate? It's through satellite systems, and Hughes is one of the big providers. And I can tell you this, these bonds have been fantastic performers. 5.25 is due 2026. We call them split rated. I think they're just fine. The balance sheets are good. A balance sheet is good. They're making money, and that's a whopping yield in the 4s for 6 years. We like them. The reason why the yields are higher than the Broadcom and the GLP and Hasbro is they're hardly followed. That's one of the big reasons. And I think that Moody's is way behind the curve on looking at them and reevaluating them. Motorola Solutions may be a name you are not familiar with. And this is a great company. Great company in the sense that, think about it. When you've got first responders, what kind of system are they on where they can talk with one another, when they can talk with the mothership? Well, they're using Motorola Solutions globally, not just here in the US. So these bonds that are due in 2029 are, they're not quite as generous yielding as Hughes Satellite, because it's a bigger issue and people know it better. But I think anything over 3% now, between now and 2029, if you can get between over 3% to a 4%, that's where you can actually say, I've got some value. Now, you could raise your hand if we were looking at each other and say, but Marilyn, I can buy American Telephone at a 5.60 or 5.80. I can buy UPS at a 4.5% yield. Yes, you can. But that's a very different situation than having an issue that has a takeout date, in which if you hold on, your maturity will happen and you'll get $1,000 face value. So high yielding dividend stocks are not a bond substitute. They are high yielding dividend stocks. And you saw the difference in the debacle last week. Even though there was not a bunch of liquidity in corporate bond land, you didn't see the desecration like you did with dividend paying stocks. That CNBC and Fox News have brainwashed people to say, or to think that dividend paying stocks are a bond surrogate. No, they're not. Either are REITs. And my whole philosophy is, it's not either or, it's and. You should be doing all of the above. Last on my bond recommendations, Seagate Technology, which I'm certain you are familiar with because it markets and manufactures hard disk drives. And Seagate is doing very well for 7 years till maturity to earn a 4.37, which is probably higher now because of the lack of liquidity last week. I think it's a gift. I think you won't have to look at bond market yield deterioration if you put together a portfolio similar or just like these corporate bond recommendations. Just like your stocks, you have to watch the quarterly revenues exceeding expenditures. You want to make sure that there's free cash flow, and that's true of all of these positions. So these are my actionable bond recommendations for this presentation today.
Marilyn?
Yes.
We have 2 questions.
Whoopee!
The first is a confirmation question. When you say tender, does that simply mean an offer to purchase by anyone?
No, it's an offer to purchase by the company. The company wants those bonds back because they want to refinance them at a lower yield. And you wouldn't get a confirmation. You would get a pop-up on your computer screen saying, Broadcom is tendering for the 3.5% due 1/15/28. You, Mr. Smith, have 25 of these bonds. Would you like to tender at a price of 102 or 1,020 or 105, 1,050? They'll give you a tender price. So you would get a pop-up on that. You would get an alert.
All right, thank you. The second question is, what is your opinion on Puerto Rico muni bonds?
Oh, I'm stunned at that question. My opinion is, if you own them and they're not insured, what have you been waiting for? If you own them, get out. This is still a very fluid situation. This situation is for the hedge funds and the speculators only. If you go back into the archives of Forbes, I wrote about getting the hell out of Puerto Rico bonds years ago, that here you had this small island with over 3 million people, that 3 million has deteriorated, and all this debt. And I'm going to talk about Puerto Rico in just a couple minutes when I talk about munis. If you own them, get out. Don't be speculating in them. That is not where you want to speculate.
All right.
I hope that answers you.
Actually, one more question came in
Sure.
just now. It is, if I am not retiring for at least 6 years, don't you think rates will likely be higher by then?
Okay, if he's not retiring for another 6 years, what was the last part before my dog barked?
Do you think that rates will likely be higher by then?
6 years from now, probably, but a lot higher, depends. I think this year rates will be very, very low. I think next year probably. Clearly, we're going into an economic downturn because of this virus. No question about that. When people are working from home, they're not out pressing the flesh and making the sales that they would have otherwise. But 6 years from now, probably a little bit higher, but I think not historically high. No. And I plan on working for many more years too. So that's why I kind of ladder things out for myself and for most of my clients, where I have some bonds due this year, next year, the following year. Maybe the ladder skips a couple of years, but I don't think they will be hugely higher. Any more questions, Celia?
That's it for now. Thank you, Marilyn.
Sure. Okay, so here's some additional ideas. How about some preferred shares? Not a bond, I get it, but the difference between the yield on a JP Morgan, Morgan Stanley, MetLife bond doing 5 to 8 years is about 2% to 2.5% lower than the preferreds. And so rather than buy a preferred ETF or a preferred mutual fund, buy the preferred yourself. You can point and click on those babies. And these yields were, as of last week, at the beginning of the week, they are higher now, because when a market is in panic, it takes down everything. We own all of these. Yes, they are all financials, but if the financials only account for 10 to 15% of the portfolio, and I wouldn't go over 15%, that's it. I think that these yields are very, very juicy. And another thing, preferreds act like a long-term bond. Yes, they have call dates, but some of them will be executed, some of them won't. So if interest rates for some god-awful reason spiked up, they would go down like a long-term bond. But since I don't anticipate that, I feel very safe and very secure in not only owning them myself and for some particular clients rather than the corporate bonds. And that's why I thought you should take a look at individual preferreds. Always make sure you look at what the next call date is, because you want to make sure that, see how I say yield to the worst call? There are some preferreds that are 5%, 6.5%, but they're going to be called this year. So it would be a negative yield if you paid $26.50 a share and you're only going to get $25 back. So make sure you do those calculations on whatever kind of calculator that your brokerage firm provides. Another idea, and they have gotten massacred this week, are real estate investment trusts. So these REITs the yields were posted as of March 11th, intraday, before I sent them to AAII, and now they're probably at least 25 to 75 basis points higher depending upon the name. And when you have a panic, everybody sold the baby with the bathwater except in treasuries. And they did that with real estate investment trust. So if you look on that last page, one of the last pages of your handout, you'll see MGM Growth is a REIT that owns and leases entertainment venues and destination resorts. Everybody's scared of that. Don't you want to buy like Warren Buffett says, you want to buy when everybody else is is selling. You know, we have a saying on Wall Street, when they're selling, they should be yelling. When they're buying, they should be crying. So you need to buy things when everybody else is flipping them out. Outfront Media got killed. Outfront Media is a great company. It's an advertising company. Billboards, they're very New York centric. If you get in a New York subway, which nobody is right now, and you see it go, you know, you see one of those lit up advertisements that goes across the screen, that's Outfront Media. And they are doing spectacularly. Plus, a lot of their billboards are now having those attachments for the 5G system, of which they're going to get additional income from that, because remember, 5G doesn't go very far. You have to have a lot of those little they're like little mini cell towers, and they're going to get a lot of money from that once this 5G really gets rolling out in the United States, and that will be for doing nothing other than providing billboards. Stag Industrials, love this company. It's a REIT investing in single tenant industrial properties, and the industrial properties have been a hot area, and I think it will continue to be. VICI Properties, it's another gaming hospitality, totally out of favor, but totally yieldy. It's probably 6% as we speak. And WC Carey has been around for ages, a net lease REIT, providing sale and lease back and build to suit places. So add on anywhere between 0.5 to 0.75% onto that yield, and I think you will make money if you have the intestinal fortitude to live through the downstrokes that we are going to continue to have until liquidity comes back into the system and until the virus news headlines are done.
Quick question,
Okay.
Marilyn.
Yeah.
Should you pay a premium to buy a preferred?
You can pay a premium, but just make sure that premium doesn't kick you into a negative return if the issuer calls them back on the first or second call date. So we want to make sure that the yield to the worst call is an acceptable yield. And the way, and I've seen so many people buy a $26.50 preferred, and in 6 months it's called, they would have a negative return of probably somewhere between 20 to 25%, and maybe or maybe not. It won't be that bad, but you want, it's not, I don't have a problem paying a premium. I just want to make sure that I'm getting an above market rate of return in the high 4s and now probably the low 5s.
So
okay.
Another question, Marilyn, we're getting flooded with questions here. It says, I have a few muni bonds since last spring of 2019. Should I just sell and take 5% capital gains?
Well, what yield are you in at? You have to be somewhat yield driven, because capital gains are certainly very enticing, but in muni land, if you've had those bonds for quite a while, you are going to get maybe half of the yield that you are locked in at. So it all depends. And now I want to talk about munis, so maybe this will help you a little bit. When I sent this out to you.
So Marilyn, Michael kind of clarified that they're actually funds, they're bond funds, and he's wondering if he should take the capital gains now, or kind of, I guess, continue to hold on to whatever yield he's getting.
Is it a leveraged fund?
That's a good question, Michael. Oh, no, it's not leveraged.
Well, the muni market totally repriced last week, Michael. There was over a 50% rise in all muni yields. So you saw your portfolio, unless it was a really short one, like 1 to 2 years, you saw your portfolio go from feast to almost famine. I wouldn't sell it next week. I would wait for the market to kind of calm down. I mean, I own personally a leverage fund. I just thought, I would do it because I had some extra cash, even though I hate muni funds, and I got nuked. I got nuked because of the repricing. And so my my PowerPoint that's up right now says, here's what people think. They think they're all boring. Well, they didn't. Nobody thought municipal bonds were boring Thursday and Friday when they were totally annihilated. Okay, when I wrote this, they were overloved and overvalued. The repricing hit Wednesday and Thursday, and munis that were due, here we go, not this one. I just want, no, all right, I'm not gonna go ahead here. Munis that in California, let's say a California general obligation bond, 2 weeks ago, 2 silly weeks ago, going out 10 years in California, depending upon the structure, all you could earn was 90 to 95 basis points, 0.90 to 0.95, not even 1%. Now you can earn about 1 1/4 to 1 3/8 due in 2021, 2 years rather than 10 years. So the repricing was wickedly horrible. Do I think that they were boring and my guys should be yawning? My answer is hell no, because the last 2 days were bloody. And so no longer are they overvalued. No longer are they overloved. Everybody stampeded out of municipal bond funds, open-end, closed-end ETFs, and there are some good buying opportunities ahead. But the gentleman who has the fund, he's got to wait till things calm down. And they probably won't calm down for a couple of weeks either. So here's what I really want to dig into, Cecilia, and that is, these are things everybody watching and listening should avoid. The whole list of non-essential municipal bonds ballooned during this municipal feeding frenzy. Everybody wanted munis since we no longer have, the deductions we used to here in California. So you want to stay away from charter schools, shopping malls, zoos, small airports, small hospitals. They are all getting not whacked, they're getting annihilated. But what you want to look at, where under my here's where to invest when yields rise, and they have risen, are the top 10 airports. You're probably sitting there, why would she say airports now when the airports aren't having hardly any enplanements? People aren't traveling. The amount of cargo is diminishing. Airports are in good shape though. They have fortress balance sheets with tons of money on those balance sheets. And what we look at with airports, whether it's San Francisco International Airport, LA International Airport, John Wayne, you always look at the latest financials and you look at how many days cash on hand do they have. You not only do that for airports, but you do it for harbor bonds. Harbors, Long Beach Harbor is getting killed. They're hardly unloading any cargo because it's not coming in from China. It's not going out. They're at a standstill. But these harbors have long-term leases and they have guaranteed annual minimum revenues. And we call those GAMs, G-A-M-S. Long Beach has the guaranteed revenues that they have cover 85% of their operating expenses. And most important, they've got 1,300 days cash on hand, meaning that they can wait 1,300 days and snip out of that cash to run the harbor until the virus has been extinguished. So I'm still hot to trot on airports and harbors with the caveat, you must know what you're buying. You always stay with the top 10 airports, and if you're California residents and in the top tax brackets, which we probably all are, I certainly am, you want to make sure that the balance sheet can withstand it. I don't want you to buy Long Beach Airport. If, they have really 2 carriers, and if one of those decides to stop going, the airport is going to do terribly. Hospitals, the mega hospitals, not the little podunk hospitals that are, going to be hanging on for dear life. The Kaiser Permanente, Stanford Hospital, Cedars-Sinai. You stick with the mega names that they're not too large to fail, don't misunderstand me, but have the lion's share of the business. School bonds, now I have to take that off the list for a while, because with so many schools closing, and schools get a very large share of their income from the ADA, the average daily attendance that is happening. I'm not sure, is the state going to still pay them even though the schools are closed due to the virus, or are they not going to pay them? So I would put schools on the back burner, way on the back burner, over airports and harbors. So there are some things you can buy individually, of which the inflows and the outflows of munis from the exchange traded funds and the open-end funds and the closed-end funds, it will affect your price a little bit, but it won't force you to freak out. Also, we love housing bonds that are FHA and or Ginnie Mae backed. Just make sure you don't pay a premium for those. Now, I have written in my Forbes articles, for those of you who have read some of them, that I've always loved essential services, and airports are essential to the economy. Harbors are essential. So I wouldn't be surprised if things get even worse for a longer period of time, that the government gives them some liquidity also. But what about water and sewer bonds in municipal districts? I've always loved those in good quality areas, but now I have fallen out of love. I've fallen out of love because so many of these water and sewer bonds, I'm going to talk about it in just a second, have thrown in the towel.
Marilyn,
Yeah.
we have a few questions from people who, I guess, really, don't deal with bonds today. And so the question is, what's the best way to learn about bonds? And it's better to kind of avoid them if you just don't know, what's going on.
Well, certainly you want to avoid them if you don't understand them and what's going on. There's a wonderful website. It's called investinginbonds.com. And it has been put together by FINRA, which is one of the regulatory agencies. And it tells you, what is a bond? How does a bond trade? Should you pay a premium? Should you pay a discount? What is a corporate bond? All of the questions, the very basic questions that whoever wrote that up would need to know. And as an add-on, it shows you which corporate bonds have traded the most in a day, what the prices were of those corporate bonds, basically what's hot and what's not. So that would be the website to go to, investinginbonds.com.
Got it. And then would they also have some guidelines on kind of age-based investing, like what percentage you
No.
Okay.
A financial planner would have that. I will tell you, I think the older we get, the less risk we should be taking in equities. A lot of people say 60% stocks, 40% bonds. As you get older, it should be flipped. But it depends upon how much money you have and how much you need to live on, annually, as to whether you have safer, more secure bonds versus dividend-paying stocks or equities in some kind of mutual fund. Okay, I better get rolling here. I only have a couple minutes left. So I want to talk about my skepticism with some of these issues that you're going to see out there. Make sure whatever you buy, if you're going to buy individual bonds, that it is a necessity to have that issue out there in the marketplace, that the issuer really is a substantial issuer. You don't want to buy the USS Intrepid. It defaulted 4 years after their bonds were issued. Sports museums are terrible. There was a National Law Enforcement Museum in Washington, D.C. defaulted 2 years after the bonds were issued. You want to make sure that you stay with essential things. And as I said 2 minutes ago, water and sewer districts are very essential. But here's the big warning, and you probably never read this or heard it, that many, many cities now are selling their municipal water districts to, there's two companies out there buying them, American Water and Aqua America. They bought 135 utilities since 2014. 135, that's a lot. And what happens is if you own a municipal water district and it's at a big fat premium and they have the provisions in their bond indenture that they can call them, or if there is what's called a change of control, it goes from ownership of the city to the ownership of American Water, then the premium that is the premium price that you see on your statement could go up in flames. So you really have to be careful. You could get killed if you have a high premium bond and your bonds get called at par. So again, we have a fluid situation. Warning, municipal water districts and wastewater districts are not the panacea they used to be. And now some of them are even issuing new bonds with the caveat that they may sell their system sometime to plug their unfunded pension liability holes. And ladies and gentlemen, another thing, if you learn anything today, the unfunded pensions are going to be much, much worse in 2020 because they own stocks, and the stocks got nuked unless we have some kind of V-shaped recovery economically and in the market. So the pension liabilities are going to be even more negative than what they were. And I've yammered about unfunded pension liabilities for years. So back to a question about Puerto Rico. We used Puerto Rico and Detroit somewhat as a template for the following. Puerto Rico had constitutional guarantees for their bondholders. Well, that turned out to be worthless. We are no longer a privileged class. We always thought we were the head of the conga line, but the judges are not standing for a distressed municipality to get skinned alive by a hedge fund or two hedge funds like is happening in Puerto Rico. I believe the rating agencies, particularly with munis, are as crooked and as inept as ever. They're a little bit better in the corporate sector than they are the muni sector. And at the end of the day, once Puerto Rico finally goes to hell in a handbasket and everything gets figured out, just like what we saw with Detroit, the people will have no memory of how bad the debacle is. So just make sure you don't get into a Detroit or Puerto Rico situation. During the Puerto Rico crisis, I had a client. He's a physician, but now retired. He said, "What do you think about me buying some Puerto Rico bonds? You know, their long-term bonds that were issued in 2014." I said, "Well, how many you think about buying?" He said, "Oh, 25 or 50." I said, "If you're right, it's not going to make any difference because you're such a wealthy guy. It's not going to matter other than you having the bragging rights that you bought Puerto Rico bonds and you made 20 points. Big deal." So make sure that the risk versus the reward is really in your total favor. So quickly, the biggest threats I thought to municipal bonds were the unfunded pensions, the tornadoes, the floods, the earthquakes. No more, ladies and gentlemen. The biggest threat to the municipal bond market now is cyber attacks. Every day, multiple small cities and counties get attacked by ransomware. School districts have been attacked. Hospitals and trauma centers. The water districts have been attacked. And look at this list. This is just a teeny bit of a list from Baltimore to Atlanta to Riviera Beach. The attackers always want Bitcoin. The cities and states, the cities and the different municipalities many times wait to tell the FBI that they have been attacked because they're embarrassed that they were so inept. They're embarrassed that their firewalls were not high enough and sturdy enough. They're embarrassed that they will be denigrated in the media, and so they don't tell anybody. So you have to be very careful. We have a person at our firm that's what he does first thing in the morning. He does a cyber search of everybody that has said they have had an attack. There was a trauma clinic in New York, in upstate New York, that was attacked. They didn't tell anybody. But guess what? all of their computers, all of their screens went out. They went dark. And what did they have to do? They had to do everything by paper. So they didn't know the client's history. They didn't know what medications that client was on because everything was computerized. So be very, very careful. You know, the small cities, the small entities are so vulnerable to these attacks. And this is the new bank robbery, ladies and gentlemen. Back to that slide that I had that talked about the disrupted versus the disruptor. They don't rob banks anymore. They rob cities. They rob hospitals. They rob trauma centers. So be very careful if you're managing your own portfolio that you know what is happening. And a lot of times you can know what's happening way before the brokerage firm does. Let's see what I've got right here. I want you to be careful of conduit issuers. These are issuers that, like Wisconsin Public Finance Authority, issues bonds for different kinds of low-income projects, nursing homes, etc. Make sure that you look under the hood. If you see a California Municipal Funding Authority, what's it for? Is it for school? Is it for a nursing home that's going to have 150 people? So the conduits are just the issuing authority. And why do they do it? Because they make money. So make sure you understand what's under the hood if you're buying these yourself. You're always better off with general obligation bonds, Kaiser Permanente, Cedars-Sinai bonds, in which you know exactly what the entity is. This screen says municipal bonds make no sense at these yields. I retract that because in 2030, on Monday of last week, you could have gotten 90 basis points. Now you can probably get a 1.5%. So 1.5% tax-free is really worth it. I had no idea we were going to have such a debacle Thursday and Friday. So I retract this and tell you that it's starting to make sense again to own individual munis. They went from grotesquely overpriced to now fairly priced. You have my corporate bond recommendations. You have my real estate investment trust recommendations. That's us. We are Envision Capital Management. We've been around for 25 years. And I can tell you this would have been much more joyful if I could have seen your faces and answered your questions by looking at you. But nevertheless, I think this went fine. And I thank you very much for inviting me today.
Marilyn, we do have a few more questions. One is there an advantage to buying closed-end bond funds over just regular bond ETFs?
I would say the disadvantage with the ETFs is the fact that I have always worried about the differential between being able to point and click really fast, getting in and out of the ETFs, but there being a disconnect between the price of the ETFs and the underlying securities. And we saw that last week. The underlying securities were being sold at tremendous discounts on both the municipal bond and the corporate bond ETFs. And that's why you saw the discounts widen. So I would say, if I had my druthers, I'd rather own individual bonds rather than an ETF. How about the closed-end funds? Most of them, at least in muni land, are leveraged. So as long as you understand the good, bad, and the ugly of that, I think that's okay. Because to get 4.25% in California is totally impossible, even with a junk muni bond. Whereas if it's leveraged 27 to 35%, you should be able to live through some of those ups and downs. And usually the leverage kills you because interest rates go up on the financing. Well, that's not happening. It killed us last week because there was a repricing of the municipal bonds themselves. And I think it's probably not a bad time to start taking a look and tippy-toeing in.
Thank you so much, Marilyn, for this wonderful session. I think even those of us who do invest in bonds, we learned a
Yes,
lot
yes.
from this session.
And it was,
Great. And I do want to say, if anybody else has any questions after they go over the PowerPoints themselves, shoot me an email at envisioncap.com. Give us a call, and certainly go to my website. I've got a lot of, I think, very meaty articles that people can read to bring themselves up to snuff on individual bonds. And the website is envisioncap.com. Thank you, everyone. Have a great day, and seize the day because we're not sick. Thank you very much.